Hello, 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 everybody. Really good to see you here. Welcome to this webinar. If this is your first time joining us, my name is Mike Supervici. I am the head of acceleration here at Desal Group. Desal Group is a company whose entire purpose of existence is to help new and emerging managers thrive. Okay, we do that through education and training, which is basically what VC Lab and the Accelerator does. We do this through a set of tools and systems, which is called Desal Hub, which has become more or less the operating system for venture capital. We have a back office offering called Desal Partners, and we have a fund of funds as well. So the whole entire purpose of existence is to basically clear the way to make it easier for new and emerging managers to thrive. But perhaps the most prevalent way that we do this is through webinars like this, where we go out and we talk about topics that are very important that people sort of care about, such as building a team and things like this. So we do these webinars every single week. And so if you haven't subscribed to them, make sure that you subscribe because we do these webinars every single week. As a matter of fact, if there's other questions that you're going to have besides the topic today, we're actually hosting on September 5th an entire AMA just for, just on venture capital and things like that. Okay. So, just know that we're always doing this. Subscribe to the next one. We're always here to help and so on. Okay. Again, I see a lot of people are starting to join now. So if this is your first time joining us, there's a chat on the right-hand side. You can go ahead and introduce yourself, say hello, but don't talk about your fund. If you have one, don't mention that. That's a general solicitation risk. That's a pretty big problem. So I wouldn't definitely not talk about that. I would just say, hello, my name is Mike. You can put in your LinkedIn, no problem. Go ahead and do that, okay? If you have questions for me, there's a Q&A button at the bottom of your screen, and I'm going to prompt you again multiple times throughout this presentation. And you can add questions there, you can upvote them, and I'm more than happy to sort of share to answer your questions when we get through it. And the format of today is that I'm going to give you a brief presentation for the next, let's call it 20, maybe as much as 30 minutes, but probably 20 minutes, just to go over all the basics around venture capital roles, around on how things work and all these other things. Then when I'm done with the presentation, I'm going to go through your questions and get into more nuance and more detail, right? But I kind of want to make sure that we sort of at least get a foundation of knowledge out to you on this very important topic, and then we can sort of get into more detailed conversations about things that you have. So if you have questions, again, there's a Q&A button at the bottom of your screen, and you'll be able to go ahead and do that. All right, cool. So let's go ahead and get this thing started. All right. So today is all about basically building a venture team. This is an area where we saw a lot of people make mistakes, and we wanted to make sure that we do this session so that we can hopefully prevent others from making mistakes. And part of the reason you see a lot of mistakes being made is that a lot of VCs that are starting new VC firms right now is that they come from like either an operator or a founder background. They've been in the startup world, and they sort of kind of build these firms with similar concepts, and there's a lot of differences, and the main difference between you starting any other business and you starting a venture capital firm is that once you start a venture capital firm, your LPs, your investors, are hiring you to manage their money very professionally for the next 15 years, 20 years of their lives. And if you pick the wrong team, this isn't like startups where you have like really nice like vesting schedules and all this other stuff. No, if the managing partners, the people that, in other words, the founders of the VC firm break up, it's like death to the fund. Okay, it's like pretty serious because you're both owners, unlike say a startup or something. So it's better to sort of do this right from the beginning. Make sure that you're partnering with the right people and things like this. And we're going to talk about that. So this is why we thought it would be important to sort of talk about this. So let's go ahead and go through initially what the structure looks like and how to think about team and team members and things like this. And then what I'm going to do at the end is kind of go through more like strategic things and stuff like that. Okay. So let's go ahead and do that. So just to kind of get a foundation for things, let's go ahead and get started with just the sort of like the roles and key responsibilities. And then I'm going to show you kind of how they scale throughout the entire organization and things like this. All right. So at the very pinnacle venture capital firm. This is like the top of the top. These are like the owners, the founders, the people that basically like run the show, are what are called managing partners. Okay. Managing partners are generally the people that founded the VC firm typically. Okay. There's, there's always some nuance or whatever to some of the stuff. So I don't want to hear like, hey, but my friend did it like this. I mean, I'm just giving you kind of like the general basics of this. Okay. And managing partners have all the power, right? Because they typically are responsible for most of the fundraising. So most of the capital that they bring in is people comes from them, and whoever brings the most capital runs the firm. It doesn't matter what the legal agreements are or anything, right? Just because they're your LPs, they're the ones that are going to make the capital calls and things like that. So they're like primarily responsible for like fundraising, and they're the ones that sort of run the firm. Okay. Um, they're responsible for building the team. They're the ones that are hiring people and things like that typically. And they're also obviously responsible for portfolio oversight. When you're like on fund one and you're just getting started, you're doing all of this stuff, and all the roles that I'm about to talk about, you're doing them all, just as FYI. But as you sort of scale, starts to become a little bit of a difference in responsibilities for various roles. Okay. So that's what the managing partners are. The managing partners are like the pinnacle. They own the firm. They're the ones that are in the management company. They make all hiring and firing decisions. They are the ones responsible for fundraising. Okay. Now, right underneath the managing partner are what are called general partners. Okay. General partners, they tend to be on a per fund basis. So generally, a firm has multiple funds, and it's very common for a general partner to just be in one fund, or maybe two funds or three funds, but maybe not all six or whatever the number is, right? So that's what they generally do. They're making a lot of investment decisions. Many of the investment decisions, they help the portfolio, and they do help with fundraising, and some help quite a lot with fundraising. Okay, but in general, like that's how it sort of works. And because of that, because they're not bringing in as much of the money or whatever, they don't have as much, what I would say in sort of like the direction of the firm as you sort of they go out and scale. Okay. Next, you have what are called venture partners. And then, we actually have an entire kind of article built in on this. It's called around venture partners, and we'll put this into the chat here for everybody. But venture partners, these are part-time. Okay. They help with very specific things like, some sourcing investments sometimes with like just domain expertise. Maybe you're like a deep tech fund, or a life sciences fund, and you need somebody to help you kind of understand if the IP, in fact, is as profound as it seems. That's an example of that. They sometimes help with due diligence, but these are part-time roles. Okay, these aren't like full-time roles. These aren't on payroll. These are just getting compensated with carry. And you can actually see the compensation structure for venture partners in the article that we put into the chat. So take a look at that. But generally, when people start a VC firm, if you're like on a fund one, it's like managing partner and maybe one or two venture partners. That's basically it. Just because you need to keep things small, and then as you scale, you build out a bigger team and so on. Okay, so that's why I put the venture partners up here, because I thought it would be helpful for everybody. Then there's below what I would say general partners, what is a principal. A principal is a person that's kind of making their way up into the firm, and hopefully at some point they become a general partner. That's their intention. They do source investments. They share in the carry oftentimes. They do have domain expertise. They're doing like a lot of market research. And, sometimes they even make like investment decisions depending on like the structure of the firm. Okay. They're a little bit more junior than a general partner, but the whole point is that they're sort of what I would call on the partner track, and maybe in a future fund they will get promoted into like a general partner as well, right? And so that's what a principal is. They're in the hierarchy, they're not as senior as the other ones, but in real life they're pretty senior individuals to be able to be at this level. Okay, so just FYI. And the final, at the bottom, what I would say like the most junior role in like a VC firm are what are called associates. And associates kind of help with all sorts of like things like, investment research, due diligence support. They put together like help with deal memos. They do market analysis. They just do a lot of work like that to sort of help the general partners like make good investment decisions. And they're what I would say the most junior folks here. Now, I cover all the stuff that I just covered. We've put together into an actual article, and we're going to share that into the chat for everybody so you can sort of just have something to sort of refer to, and then we'll put that in there as well. It's basically what are the VC roles, and so we'll go ahead and put that in the chat for you so that you can go through this on your own time whenever you have time. Okay, cool. So now that we've had this, let's sort of like look at like the kind of progression and how things actually work from like fund to fund to fund. Okay, so if this is, again, like your first time going through this or understanding this, a firm, usually has a number of funds. No, it doesn't make sense from an economics perspective or a business perspective to do like one fund. If you're going to go into this business, you want to have multiple funds under management. Otherwise, you won't be able to build a company. You're going to go out of business. You're going to run out of money, all sorts of stuff, right? So basically, the progression goes something like this, okay? Most people are going to do a fund one that's generally very small, sometimes 5 million, maybe sometimes 10. Some people can do a little bit better, but typically worldwide, 5 to 10 is pretty normal, okay? So you're going to be pretty lean, right? Like for the whole 10 years, you're going to make like $1 million. So it's like 100,000 a year, right? It's not that much, okay? This is where you're going to like learn the business, you're going to, the LPs are kind of betting on the manager. And this is a pretty lean operation. It's basically like the managing partners by themselves. Maybe sometimes they have other people, but basically it's super lean, right? Then in fund two, you're starting to kind of build a little bit of a business, okay? Your fund's a little bit bigger. You're making a little bit more money in terms of like fees, and you're like starting to kind of scale the business with fund two. And in fund three, if you pull this off, now you sort of become enduring. Now you have more fees. Now things are sort of kind of, you actually have all these fees stacking up, like fund one, fund two, fund three. And we're going to, if we can put this in the chat, everyone, scaling a VC firm, go ahead and put that in the chat, please. I'd appreciate it. You can kind of see sort of how like the economics of the business work, and you're going to be able to pay more people, hire more people, and all these other things. And then fund four, fund five, now you're enduring. You have a pretty legit LP base that's going to constantly invest with you over time. So this is kind of how this generally works. So let's work through like the team structure through these kind of phases of like a firm launch. Okay. So in fund one, like I said, it's basically the managing partners, and you're going to have some venture partners, some people that are able to kind of raise enough money, let's call it in the 10 to 20 million range. You can now have enough fees to maybe afford to pay somebody to kind of be an associate or something. But most fund ones are basically a managing partner or two, and a set of part-time venture partners that are being compensated with carry. Okay, that's what fund one looks like. And you're going to do fund one like this, and in 2.5, 3 years, you're going to go over to fund two. Okay, fund two is a little bit bigger, right? Like I said, and now you're starting to kind of build a little bit of structure. Maybe you have a principal that you can hire that you're going to maybe try to develop into a general partner or something. You have some associates, right? Maybe a set of associates, and maybe, maybe some venture partners, okay? Right? So that's kind of what like a typical fund two looks like. And, there's variations to this. Sometimes people will bring in a general partner in fund two if it's big enough, but generally this is a good way to sort of think about this. And then when you get to fund three, maybe you promoted that principal into a general partner, right? So now you have a general partner for that fund as well. Maybe you have another principal that you're developing for future funds and things like this, and associates, right? And then this could be sets, right? This could be even sets of people, depending on how much money, how big your fund is, and everything like that, right? So sort of everything's kind of like set up, and you have like all those like sort of roles put together and so on. Okay, so now you have kind of like the team structure. Now, the other component of all this, right? And this starts from like the very beginning of fund one, is all of your operations, all right? And so in fund one, you're going to outsource, and in fund two, fund three, probably you're going to outsource this. Fund four, you may start to insource some of these things, but in general, you're going to need to bring in kind of what I would call back office operations. Okay. And that is all of your legal, which is like your closing, compliance, everything. You're going to need treasury. You're going to need accounting. These are all things that you need to do. Okay. And because a lot of these funds are small initially, a lot of GPs cut corners. So a lot of the GPs that came before you have cut a lot of corners, and therefore a lot of LPs don't want to invest in your funds. So don't be like your peers, right? Like do this right from the beginning. Make sure you have everything sort of set up. And there are, there are things like Decile Partners, for example, that handles all this stuff, or you can kind of cobble this together with like a set of vendors. And most of the risk for LPs is sort of in compliance and treasury. And this is where like most of the fund admins don't do this, right? So you're going to have to figure out how to do this either on your own, or you have to like, hire resources to help you with this stuff, right? So this is like KYC and AML, something that a lot of people don't do. Regulatory sanctions, there's serious sanctions risk right now and stuff like this, right? So you're going to need to do this from day one. So a lot of people try to say, well, I'll just do this in fund 2, fund 3 when I actually have the bigger fees so I can afford more of this stuff. You can't really do it like that, because if you don't do this right from the beginning, you won't be able to raise a fund 2 or a fund 3, right? So this is kind of what like the actual team composition looks like. There are ways to sort of mitigate a lot of these costs and things like this. For example, Decile Partners is really good about this because it kind of handles everything under one roof. There's no like issues with like, lawyers talking to treasury and what's right or whatever. But, you really need to be super on top of this. Otherwise you will never get to fund 2 or fund 3 and you won't be able to build a firm. Okay, cool. And again, I just want to be clear, like emerging managers have a really bad rap right now around this stuff, because a lot of people have cut corners, especially during the heyday of like venture. And there's literally people out there that have never KYC'd or AML'd any of their LPs, right? So just think about that, right? It's pretty bad for LPs, it's pretty bad for everybody else. So take this serious. Okay, so let's talk about like some best practices. And I see that there's quite a lot of questions coming in, and we'll turn it over to that. Okay. All right. For those of you that join a little bit late, this isn't building a VC firm is not like building any other company. Okay. Your LPs are hiring you to manage their money for the next 15 to 20 years. This is like a serious like fiduciary responsibility. And good LPs that know what they're doing, they're going to want to see that you can actually have multiple funds under management so that you can actually build a business. Because the worst thing that can happen for LPs is that you only raise one fund and you can't raise fund 2. And then, they're going to be in trouble in year 8, 9, 10 when you have very limited fees. Okay. So you got to build this firm in a way that's enduring. Okay. So what does that mean? Well, you got to partner with people that this isn't like a startup where you have these very nice vesting schedules and it's like really easy to kind of fire a co-founder. No. If the managing partners break up, it's death. Okay. It's like that. It's super bad. It's really, 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 really bad. It's really difficult to recover from this. That's how you should be thinking about this. Is there exceptions to the things that I say? Yes. I'm just trying to make a point to you about how to think about this, because I see this all the time in our accelerator program where people are like partnering with some random person that they don't really know. Like you can't do that when you're launching a VC firm. Remember, you're committing you and your partner are committing yourself for a 20-year thing to be working together for the next 20 years, right? It's a serious commitment, right? And if there's a breakup, it's really bad for everybody involved. Okay. So you need to have an extensive working relationship before you choose to partner with somebody. So this isn't like, hey, we were like friends, like, no, you all should have like been able to work together and been able to test each other in stressful situations, because again, you all are going to be working together for the next 15 to 20 years. It's a long period of time that you're committing it. Okay. I said this thing here, the management company is sacred. Okay. So there's usually 3 entities that are set up for VC firms. There's the management company. Right underneath that, there's a general partnership. That's where the carry is. And then right below that is the LP entity. That's where your LP sit. The management company is sacred. Do not allow anybody in your manco except the managing partner or partners. If an investor wants the piece of the manco, don't give it to them. If you think a person like needs some manco shares in order to kind of join you as a team, don't do that, or you'll become resentful. That's because whoever's in the management company, okay, gets carry in every single fund that you're going to create from here on out. So if a person doesn't work out in fund one and they leave, guess what? They're just going to keep getting carry of all the work that you do in year 25 or 20 or whatever, right? So this is sacred. So be very careful with who you allow into the manco, okay? And then finally, test people. I don't know if you remember kind of seeing the progression there. Remember how I put somebody in principal in fund two, and then in fund three, they got promoted to general partner? That's an example of that. Or in fund one, you can test people out as venture partners, and if they become very, very good, maybe in fund two, you promote them to a principal or general partner, right? Because you've tested them out and you've worked together extensively for 3 years and you've built this relationship, okay? That's how you figure things out, right? You figure things out by testing people with these things where they're sort of contained to like one fund versus the manco. And then you have everything that you need to do to make an educated decision of whether or not this person has the potential to be with you for a long time, okay? With regards to operations, this is another place where people make enormous mistakes. And again, this also often means death. You have to work with very specialized vendors, okay? You can't work with like a law firm that does a whole bunch of other things and maybe they do VC stuff. Like if the law firm is good at private equity, that doesn't mean they're going to be good at VC. So you need to work with people that understand venture capital, only specialize in venture capital. Same thing with back office and accounting. Like you cannot work with accounting folks that don't understand venture capital. I don't care if they've spent all their career at managing hedge funds or whatever. That's a different thing, very different thing, right? So you have to work with like operational partners that specialize in venture capital. And because I'm assuming that everybody here is basically an emerging manager, then you have to work with people that actually understand emerging managers, because your business is very different than other people's businesses, right? You're not going to have the fees like we discussed to be able to afford things like this the way that the other folks can and all this other stuff, right? So you have to work with very specialized vendors, okay? And you have to work with like super reputable administrators that understand what they're doing, right? Like that's the key, right? Because if people know what they're doing, then you're not going to have issues with compliance and all these other things that are pretty normal in for emerging managers, right? And then finally, you gotta take compliance super seriously. Like you cannot have, for example, somebody wire from a bank account that doesn't match the legal agreement. That's a kind of compliance 101 thing. What does that mean, right? It's like, it basically means money laundering, right? Like if the legal agreement and the bank account don't match, that's how money laundering happens. And it could have been an innocent mistake. And I'm not saying that the person's evil or something, but this is how and why this stuff is important. So you have to have compliance. You have to have a super robust operation because you're a professional money manager, right? This isn't like a startup, right? This is like a serious, serious, serious responsibility that you're signing up for. And if you don't have all these things in check right from the beginning, from fund one and even fund two, it's going to be almost impossible for you to raise fund three, fund four, fund five, because LPs are going to be like, well, what's been your compliance policy? How have you dealt with this? Da, 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 right? Because they want to make sure that their money is safe. And, put yourself in the shoes of a limited partner. Wouldn't you want to invest in, if you're going to invest in something like this, like, wouldn't you want to make sure that it's being handled correctly? Right. So even though like most of you are going to be basically like what I would call startup firms, you're not that different other than the size of your assets under management than like a Fidelity. Okay. You're not that different. You're still professional money managers. And so you got to make sure you have your operations super buttoned up. Okay. All right. We have a program, VC Lab. Go to VC Lab, apply. We cover all the stuff in great detail and all the stuff. So go ahead and apply. And I just want to, put another call to action really quick before we switch to the AMA portion of this. Again, if you have questions about venture capital in general, we're hosting another AMA on September 5th. So go ahead and register for that. And we put it in the chat. We can put it into the chat again. Happy to kind of help and give you as much knowledge as we can.